In March 2014, the Bank of England published a quiet technical paper that should have been front-page news everywhere. It confirmed something critics had been saying for decades, and were routinely dismissed, ridiculed, and ignored for saying. The money in your bank account was never really there. Not in any traditional sense, anyway. The official story says banks take your deposits and lend them out. That's the textbook version. Every economics student learns it. But the Bank of England's own economists, McLeay, Radia, and Thomas, wrote it plainly. Banks do not act simply as intermediaries, lending out deposits that savers place with them. They went further. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. The loan creates the deposit, not the other way around. That one sentence overturns what most people believe about the entire financial system. And the implications don't stay abstract for long. They show up in your rent, your mortgage, your grocery bill, and the slow erosion of everything you've saved. To understand why this matters, you need to understand what fractional reserve banking actually is, and how it became so deeply embedded that dismantling it now feels almost unthinkable. The practice began, as many financial innovations did, with Italian merchant banks in the 14th century. The Medici Bank, founded in Florence in 1397, was one of the earliest institutions to perfect it. But the mechanism was truly industrialized in 17th century England. Goldsmiths accepted deposits of gold for safekeeping and issued receipts. People used those receipts as money. It was easier than carrying gold. The goldsmiths noticed something crucial. Most depositors never came back at the same time. So they started issuing more receipts than they had gold. The receipts still circulated. No one noticed. The goldsmiths collected interest on money they had simply invented. That's the origin of modern banking. A clerical observation about human behavior turned into a structural feature of civilization. The Bank of England was founded in 1694, partly to regulate these practices. By 1863, the U.S. National Banking Act required banks to hold 25% of deposits in reserve. By the 20th century, that number had dropped to 10%. And then, on March 26, 2020, quietly, during the chaos of a global pandemic, the Federal Reserve reduced reserve requirements to 0%. Zero. Every American bank now operates with no mandatory reserves whatsoever. This was barely reported in mainstream media. The Fed replaced reserve requirements with interest paid on reserves, held voluntarily at the central bank. Critics have a name for what came next: zero reserve banking. But even before 2020, the reserve requirement had been more of a theoretical floor than a real constraint. Because banks don't wait for deposits before making loans. That's the deeper truth. Professor Richard Werner at the University of Southampton ran the first empirical test of this in 2014. He borrowed 200,000 euros from a small German bank and watched the internal bookkeeping in real time. No transfer occurred from existing accounts. No reserves were moved. The moment the loan was approved, new numbers appeared in his account. The bank had created money at the point of lending, from nothing. Werner's paper confirmed what the Bank of England had admitted the same year. The money multiplier model taught in universities is not just oversimplified, it's wrong. The money multiplier, the idea that a bank with a 10% reserve ratio lends out 90%, that 90% gets deposited elsewhere, and 90% of that gets lent again, expanding the original dollar into 10. That's presented as a mechanism of careful, controlled expansion, but it describes something that doesn't actually happen in that sequence. In reality, banks create loans first and find reserves later, if they need them at all. The practical result is this. Roughly 97% of all money in the UK economy exists not as physical cash issued by a government, but as numbers created by private commercial banks through the act of lending. 3% is coins and banknotes. The rest was typed into existence by institutions whose primary obligation is to their shareholders. And what do those banks lend against? Productive businesses, the factories, the startups, the infrastructure that grows an economy, receive less than 10% of total UK bank lending. Nearly 50% goes against real estate. Banks aren't primarily financing economic growth. they're financing asset price inflation. This is where Austrian economists enter the argument with their sharpest knives. Murray Rothbard called fractional reserve banking a shell game, a Ponzi scheme, a fraud in which fake warehouse receipts are issued and circulate as equivalent to the cash supposedly represented by the receipts. He compared banks directly to counterfeiters. Spanish economist Jesus Huerta de Soto, in his exhaustive work, Money Bank Credit and Economic Cycles, identified a specific legal impossibility at the heart of the system. When you deposit money in a bank, you believe it is being held for you, like property stored in a warehouse. But the bank treats it as a loan from you, which it then lends to someone else. Both you and the borrower simultaneously believe they own the same money. That's not a technicality. That's two people holding deeds to the same house. If this sounds like fraud, the defenders of the system have a ready answer. You agreed to it. The terms and conditions say your deposit becomes the bank's property. You receive a promise of repayment, not custody of your funds. This is legal, regulated, insured. The FDIC in the US covers deposits up to $250,000. Capital requirements under Basel III and Ivy add further safeguards. Mainstream economists like Federal Reserve economist David Andolfado argue the system isn't inherently fraudulent. It's a disclosed contract that enables credit creation, economic growth, and the mortgages that let ordinary people buy homes. That argument holds up until you ask one question. What happens when too many people want their money at the same time? The answer has a name, a bank run, and it always exposes the same truth. The money was never all there. In 1930, the Bank of the United States collapsed after depositors lined the streets demanding withdrawals. In 2007, UK bank Northern Rock suffered the country's first bank run in over a century. Customers queuing around the block after the institution admitted it needed emergency lending from the Bank of England. In March 2023, Silicon Valley Bank received $42 billion in withdrawal requests in 48 hours. It was closed by regulators on March 10th. Within 2 months, Signature Bank and First Republic had also failed. 3 of the 4 largest bank failures in US history happened in a 2-month window. The SVB collapse added a new dimension. Depositors didn't queue outside branches. They clicked a button on their phone. Digital banking has made the structural fragility of fractional reserve banking faster and more acute than any regulator predicted. The lender of last resort, the central bank, exists specifically for this scenario. When fractional reserve banks face a run and reality meets the math, the central bank creates new money to bail them out. The Federal Reserve was created in 1913 for exactly this purpose. A systemic safety net built into the architecture because the architecture itself is inherently insolvent. There is an economic theory for why this creates recurrent disasters. Austrian business cycle theory holds that when banks create new money, they push interest rates below their natural market level. Cheap credit looks like abundance. Businesses make long-term investments that only made sense at those artificially low rates. Households borrow and spend beyond their means. A bubble builds not because of greed or stupidity, but because the price signal for money itself is wrong. When rates rise or credit tightens, those investments fail. The recession isn't a bug in the system. It's the correction of a distortion the system created. The 2008 housing crisis fits this template precisely. Cheap mortgage credit, created through fractional reserve lending and sliced into complex financial products, built an asset bubble that required a global bailout when it collapsed. And throughout all of this, something quieter is happening. More gradual, less dramatic, but in some ways more corrosive. Every time a bank creates new money through lending, the total money supply expands. More money chasing the same goods. That's inflation. But inflation doesn't distribute its costs evenly. The people who receive newly created money first, banks, their largest borrowers, well-connected institutions, spend it before prices have adjusted. They get full purchasing power. By the time that money circulates to ordinary wage earners and savers, prices have already risen. The latecomers bear the cost. This is called the Cantillon Effect, named after 18th century economist Richard Cantillon, who first described it. The reform group Positive Money calculated that British banks earn approximately £23 billion per year in effective hidden subsidy from their money creation privilege, not from providing a service, from holding a legally protected monopoly on creating the thing everyone needs. Reforms have been proposed for nearly a century. After the Great Depression, Irving Fisher and economists at the University of Chicago drafted what became known as the Chicago Plan, requiring 100% reserve backing for all demand deposits. Milton Friedman endorsed full reserves in his 1960 book, A Program for Monetary Stability. Martin Wolf, chief economics commentator at the Financial Times, endorsed full reserve banking, arguing it would bring huge advantages. Iceland seriously considered it after its catastrophic banking collapse between 2008 and 2011. In 2018, Switzerland held a public referendum on the Sovereign Money Initiative, which would have transferred money creation power from private banks back to the state. 75% of Swiss voters rejected it. And in December 2025, a company called N3XT Inc. launched the first full reserve narrow bank in the United States, receiving a special purpose depository institution charter from Wyoming. One bank, in one state, as an experiment. Bitcoin, created in 2009, was born directly from this moment. Satoshi Nakamoto embedded a message in the Genesis block, a newspaper headline that read, "Chancellor on brink of second bailout for banks." The choice was deliberate. Bitcoin's fixed supply of 21 million coins makes fractional reserve expansion structurally impossible. Whether that solves the problem or creates different ones is still being argued, but the diagnosis behind its creation is now officially confirmed. A 2014 poll by Positive Money found that only 1 in 10 UK members of parliament understood that private banks create money. Not the government, not the central bank. Private corporations operating under a state-granted license with profit motives and shareholder obligations, creating the money supply of an entire economy. What remains unresolved is what to do about it. The defenders are right that credit creation has funded real economic growth. The critics are right that it concentrates power, creates instability, and transfers wealth invisibly from those who save to those who borrow and issue. Both things can be true simultaneously. What cannot be honestly argued anymore, not since March 2014, is that the system works the way most people believe it does. The Bank of England said so. The evidence of 3 bank collapses in 2 months said so. The 0% reserve requirement said so. The money you believe is sitting in your account was created the day someone else took out a loan. That loan may have already been spent, invested, or lost. You hold a promise. The system holds its breath. And everyone hopes not too many people ask for their money back at once.